Hello, everyone, and welcome to this weekly market recap for the week ending Wednesday, November 20th, 2024. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats.com. It's a pleasure to be back with all of you again this week. Kind of a boring week so far this week in terms of economic news, earnings news slowing down as well. This evening, we did just get the NVDA report. After hours, I can give you the number. So I'm doing this as of Wednesday evening for the period Thursday of last week, which would have been the Thursday the 14th through Wednesday this week, the 20th. So that's the period that we're covering. After hours, NVIDIA down about 1.2%. So unable to make a new breakout with its earnings report, but not really breaking down either. Unfortunately, however, for the semiconductor group, NVIDIA is your leader. So if your leader is not able to make a breakout with its earnings report, I think maybe we're probably still looking at that group kind of treading water here until we can get a big breakout on some individual stocks, and especially on the semiconductor index in aggregate. As far as the economic reports out this week, we did have we had the building permits out earlier. I think that was on Tuesday, along with the housing starts. Both came in a little bit above expectations. So I think the economy is still fine. Interest rates kind of holding fairly steady. They were up a little bit today on Wednesday, but overall, I think they've been kind of in this maybe 4.33% to 4.50% range. And I think we finished today around 4.42. So overall, I think the 10-year Treasury yield's kind of hanging in. And this has been a period where we went into this week. Of course, last week we had November monthly options expiration on Friday. We had negative divergences last week. We're in the middle part of November, which historically can be not really bearish, but not bullish either, just more of a sideways consolidation. That's been the history of this time during the month of November. So I think when we look at all this, put it together, I think the market's doing about what we would expect. I mean, we've seen a little bit of a pullback. We've seen some selling because of options. I think we've held so far, for the most part, rising 20-day moving averages. So overall, I think the action has been about what I would have expected this week. But I do see brighter days ahead. I do think the market is getting ready to make a rush to the upside. But let's go ahead and take a look at what we've seen over the last week or so, and then we'll go from there. So let's start off first with the Dow Jones. Dow Jones down 120. This, of course, is just for Wednesday. But you can see the last week or so, we've made our way all the way back down, test the 20-day moving average, also gap support just below 43,000. That's been an area of support that we went down, approached, and then reversed back up today. S&P 500, actually some of the indices not really showing exactly. Yeah, the spider, which tracks the S&P 500, was up 3/100ths of 1%. S&P 500, so you can see just kind of hovering right around its 20-day moving average, but that is a rising moving average, and it is above the 50. So we've got a really good configuration. This is what I would consider very bullish configuration, where the market got a little bit ahead of itself, negative divergences formed. We had Max Payne option expiration week, and we saw some overbought conditions resolve a little bit to the downside, bringing in maybe, just a little bit of short-term selling. But from here, if we hold this 20-day moving average, and we did a pretty good job of that late in the afternoon with some strength coming in, I think this could set up for a rally off of this level. So anyway, something to consider as you think about your trading on Thursday and over the course of the next couple of days to a week. NASDAQ, and by the way, historically, things start to pick back up again as we head toward the end of November. So we're starting to turn now back into a more bullish historical period. NASDAQ 100 also pulled back. You can see just doing a lot of sideways, back and forth action right around the 20-day moving average. I think all of this is pretty bullish. Mid caps, same thing, pulled back. right near gap support, near the 3,200 level, near that 20-day moving average. IWM, pretty much the same, pulling back, 20-day moving average, gap support, price support, all being tested. Transport's pulling back, holding on to gap support, actually well above gap support, but coming down and testing that 20-day moving average as well. So I think this past week has really been characterized more of just some profit taking. I think probably maybe a little bit of manipulation by market makers, bringing prices down, wiping out some of the in-the-money call premium relating to the November monthly options. So I think, again, a lot of this is what I would have expected, what I was looking for. We have portfolios at EarningsBeats. We actually got out of them last Tuesday, midday, actually in the morning, because of some of these issues that I've talked about. I thought we would see a little bit of downside. We've seen that. I actually think from here we might be ready to make another push to the upside. So I certainly would be considering that in terms of your planning. Moving on to some of the sectors, I wanted to show you over the course of the last week, utilities. Now, anytime the market pulls back, we normally see more defensive areas do better on a relative basis. That's just the norm, because usually leading up to these periods of selling, we have a lot of aggressive groups that are leading the action to the upside. So it makes sense that we would see that kind of selling to just relieve some of the overbought conditions, to see some of the profit taking and so forth before we get another leg higher. But utilities were stronger. So we saw utilities push back up above both moving averages. You can see that throughout the week, pretty much buying throughout the week last week, which has been good. We also had energy, which had been beaten down. Energy over the course of the last couple of weeks, gapping up, continuing to move back to the upside. And honestly, this is a little bit surprising with crude oil still remaining down below $70 a barrel. But I think we're going to probably need to see that crude oil, crude oil prices move higher in order to get this XLE breakout above the April high, which is up near 97. So a couple things to consider there. Looking at healthcare, healthcare has been under a lot of pressure. This is one of the worst groups over the last week. You can see last Thursday and Friday, extremely weak. Trying to kind of gather ourselves here this week, starting to turn back to the upside. I think healthcare could be really strong from here into year end. I'll tell you why in just a minute. But let me pull up the other sector that was very weak this week, which was industrials, pulling back. But notice, look at that nice little hammer printing today, right at that 20-day moving average, trading below it intraday, coming back up at the end of the day, closing above it. I think this could be a really good sign in the near term for the industrials. But let's go back and take a look at that healthcare. I wanted to bring up a weekly chart and show you a little bit of what I'm looking at here. I think we're at a really key support level. We're getting very, very close to a key support level on this group. Let me drag this support resistance line down. You can see that back in April of 2022 on the way up, the XLV topped at about 137. And notice later in 2022 in December, we came right back up. Where did we go to? 237. Couldn't get through. Pulled back again. Over a year later, finally we go through, or I may have said 237, 137. Anyway, we finally get through that 137 level, get up over 145. When we pull back to relieve some overbought conditions, where do we pull back to? 137. Make a new high, and here we come down again. Where's our key support level? 137, right? So XLV getting very close to that 137 level. We got as low this week. We've seen as low as 140.26, and our recent highs up near 160. So we've got very little downside risk and a lot of upside potential, especially in what I believe is a secular bull market advance. I suspect that we're going to see all areas of the market participate. Not all areas lead. Obviously, not everything can lead at the same time. I expect that healthcare will bounce. I don't know that there'll be a leader, but I do expect to bounce. And I do think we're protected a little bit to the downside at that 137 level, just because of this long-term chart. We don't want to lose perspective. Sometimes in the short term, we see a lot of weakness and we just grow overly bearish. I think it's helpful to pull up this long-term weekly chart and see where that long-term support resides. And that's right around that 137 level. All right, going back to our major indices, I just wanted to kind of point out, here was our pullback. There's that 20-day test bouncing off of it. We go to the S&P 500. That was the Dow. S&P 500 pulling back, gap support, price support, moving average support, bouncing off of it, looking good so far. The QQQ, which tracks the NASDAQ 100, pulling back into gap support, just below price support, kind of hovering right around this 20-day moving average. But the last 3 days, I mean, if you look at this week, Monday, Tuesday, Wednesday on the QQQ, we have finished almost right on the high every day. So any weakness we're seeing it in the morning, and then we're seeing some nice buying throughout the rest of the day. And as a result, even though we've pulled back, you can see the AD line ready to make another breakout. So I think the action on the QQQ looks really bullish to me. And then next up, wanted to show you the IWM. Again, pulling back, price support right around 227. Gap support, we didn't quite get all the way down there, but you can see again the 20-day moving average. Last 2 days we've been below the 20-day moving average in the mornings, but by the afternoon we're closing on the highs. Really nice finish today on the IWM, by the way. I wanted to pull up the intraday chart. Look at the last 2 hours. We were down near the low of the day, or getting close to the low of the day, about 2 o'clock, a little after 2. And then in the last 2 hours, we rallied back, finished on the high of the day. And one of the things I wanted to show you on this particular chart was the bottoming, what I think could be a bottoming head and shoulder pattern. So let me grab this, bring this across right there. And so if you look at this, you're coming down, left shoulder, neckline, a lower low puts in the head, equal right side of the neckline. Look at the right shoulder here, which is exactly symmetrical with the left shoulder. And then we rally into the end of the day and we take out the neckline right into the close. I think that could be a very bullish signal in the short term, because we'll find out tomorrow and on Friday, see if we finish the week out strong. But I do like the way we finished the last couple hours today, and I think that could set us up for some more bullishness as we go down the road. Sentiment. I wanted to talk a little bit about sentiment. This is something I share with our members every single week. I like to look at the 5-day simple moving average of the equity-only put-call ratio. When we're too complacent, meaning too many calls being bought versus too many puts, we see this 5-day moving average move down below about 0.56 or so. And that's marked by all of these red arrows, meaning these are red flags. I'm showing you red arrows, but that's a red flag. And if you look at the timing on almost every one of these red arrows here, look at where they are in terms of the price chart on the S&P 500, and look at what happens simultaneous, to that or subsequent to that. Usually we get a pullback. Now, this isn't a long-term bear market signal. It's a short-term caution signal or caution flag that, hey, we're getting a little bit complacent, a lot of calls being bought. Of course, retail traders tend to get it wrong more often than not. And so when we start seeing that complacency in the options world, we should start to grow a little bit more, pessimistic or a little bit more bearish or just cautious in the near term. And that's what that was telling me. We've started now. This was as of last Friday. I update this every Friday for our members, and then put it in our weekly market report, which usually goes out on Mondays the following week. But this is important to watch, especially if you're a trader, because when we do get too complacent, it makes sense to kind of, pull back the reins a little bit on your long positions. Now, from a longer term perspective, I love to follow the 253-day moving average of the equity only put call ratio. Why 253 days? Well, it's 253 trading days, which is actually the equivalent of 1 year. So it's just, the 5-day moving average I consider like a speedboat, short-term kind of a sentiment indicator for us. This is more of a long term. And I want you to look at when we get too fearful in the market and we start to roll over on this long term 253-day moving average, when this is coming down every single time, look at what the market does. Stock market goes up, goes up, goes up, goes up, goes up. And we're still in free fall mode. We have not bottomed yet. So that's why I remain very bullish the market, or one of the reasons why I remain bullish long term. Sentiment is telling me to do so. Anyhow, moving on, anybody who is interested in signing up for a no-cost trial to our service, you can go over to earningsbeats.com, click this Start Your No-Cost Trial button, very simple. I would suggest if you're new to EarningsBeats, scroll down and sign in for our EarningsBeats Digest newsletter. It comes out Mondays and Wednesdays. I have been so bullish, small and mid-cap stocks, and they have been exploding. We're going to be writing more and more about these down the road. So make sure you subscribe. Name and email address is all it takes. No credit card required. You can unsubscribe at any time. But I really think this is going to do you a big favor over the next few months. Like I said, we've been focusing on some small cap stocks. A week ago, I put out a video listing 10 small to mid cap stocks that I liked. I think 4 of them in less than a week, 4 of them are already up in the 7 to 10% range this week. I think only 2 are down. 8 out of 10 are up in a flat market. You really need to be looking at small caps. I'm literally giving away some of my favorites. You're going to see more of this on the EarningsBeats Digest newsletter. So make sure all it is, name and email address, hit that subscribe button, check it out. From a performance standpoint, I just want to point out over the last 90 days, when we have been preaching small and mid-cap stocks, August 19th to November 19th, look at the returns we've had in our portfolios. Model portfolio, 21%, aggressive portfolio, almost 26%, and the S&P 500, less than 5% rise over the same period. So we're talking about 5 times return on the model portfolio last quarter, and we're talking, or excuse me, 4 times and 5 times on the aggressive. You know, and if you go back to 2018, which is when we started the model portfolio, 6 years in, we've more than doubled the S&P 500. That's a pretty long time to show that kind of outperformance. We have themes. We believe in our themes. We invest in these portfolios based on those themes. If you become a 30-day trial member, we just announced yesterday, well, Monday, but we got into all of our new portfolios today, or as of yesterday's close. So today was our first day, and we had a couple of really big winners again today. You've got to be aware of what's going on in the market with these small caps and mid caps. So please, please, please check that out. If you're on your mobile device, you have a slide up right now with a QR code. You can simply scan that QR code, go right into the landing page, and make sure you get signed up for this EB Digest. I'm telling you, I've been saying for the last few months, that the small and mid cap stocks are ready to take over. I think it's just beginning. I think we're going to have a big, big push ahead, and knowing some of the stocks that make sense, I think really important right now. So please make sure you join us over at EarningsBeats with the EB Digest. It's a free newsletter, free, completely free. We do this to give back to our community. I think it's a really good educational newsletter as well. So please check that out. All right, a couple things before we wrap up here. I want to go through and talk about some individual charts that I think look kind of interesting. Cava Group, this is in the restaurant area. Big gap up with earnings. They came out with great numbers. The biggest problem with this chart is it's just been going up. So we had a buy on rumor, and then we've had a sell on the news. But this stock was up over 170 and recently came back down below 135. I really like it. I think it's consolidating here, kind of getting its feet under it. But I think we're going to make another push up toward that 170 level in time. So this is a stock that I certainly am interested in. COHR, this is a stock recently made a breakout to a new high, pulled back all the way to the 50-day, Beautiful reversal on Tuesday. I think any kind of selling here could set up for an opportunity on Coherent. You look at that AD line strengthening up, come down here, look at relative strength versus electronic equipment. It's been going up for many months. The actual group itself has been outperforming. So you got a nice leader in a nice group. I think Coherent is very strong. Roblox. Now, Roblox would have made it, didn't make our portfolios this quarter, and I'll show you why in just a second. But the AD line, awesome. Go down here, look at relative strength. Just broke out to a 52-week high. Everything here looks good. Big volume on the gap up to take out resistance. I mean, I can't overemphasize how strong this stock has been. Holding above its recent support, holding above the rising 20-day. Everything looks great, right? Well, sort of. If I go to the weekly chart, that's where I have just a little bit of pain, looking at this chart. And that's because on the way down, this huge move down, we had a rally from about 36 up to about 53. Went down to another low all the way down near 20. And where did we rally back to? Right about 53, maybe 54. And then what has happened since back in the middle of 2022? We have literally traded in this range between the May low and the August high from 2022. Everything that is traded over the last almost 2.5 years has been in that range. And so we came back up. The daily chart looks great. And we did go above 55 on an intra-week basis, but we haven't been able to close above 55. And that's what I'm waiting for. That's the only thing I'm waiting for. We are, definitely trending higher at this point, 20-week above the 50-week. I mean, I think things look pretty good, but we still need just that one piece of confirmation. I'd like to see it close above that 55 level. Just a couple more stocks here. I want to pull up Corning. GLW, again, on a weekly chart, you can see it moving up, taking out the highs from 2021. If we go to the daily chart, we do see during this period of consolidation, the AD line coming back down a little bit, relative strength coming back down a little bit, but that's starting to turn back up again. And now that we've gotten down all the way basically to gap support, price support, 50-day moving average support, we're now starting to bounce back and move back to the upside. That's what I would be looking for in a lot of your charts as we go forward. A couple of smaller stocks that, let me pull up ATGE. Really good move here, taking out the highs from back in July. Love this move. Volume picks up. AD line remains strong. Look at the relative strength. New 52-week high just hit a week or so ago prior to this pullback. I think the 20-day moving average gap support provides really good support here. And let's do one more, RH. This is one that had gone up to almost, probably somewhere around 365. Pulled all the way back down to this gap support, or not gap support, but price support. We got gap support just a little bit below that, though. So I'm looking at 303 up to 310 being really good support here. We just came down to about that 310 level, and then we moved back to the upside. We've had a solid week this week. I see RH going back up into the mid 360s, probably sooner rather than later. Anyhow, that's basically what I have for you today. If you go to the slide that's up on your screen now, if you want to follow us at EarningsBeats, I'm pretty available in a number of different areas on YouTube and, of course, over at Stockcharts. But if you scan the QR code that's up on your screen right now on the slide, that will take you to a landing page where you can learn more about how you can follow us at EarningsBeats. Really would love to have you. I think this is a real critical time right now in the market. I've been saying that for the last probably 3 to 4 months, but we're starting to get confirmation of it. And so I think to really be set up properly in this market, you've got to be paying attention to the rotation, the shift that's taking place, what is likely to lead, because a lot of us tend to look at, we have recency bias, and whatever's been working for the last year, 2 years, 3 years, we think that's just always going to be the case. It's not always the case. And we are seeing a very significant shift right now. So come on over to EarningsBeats. We'd love to have you. Follow me. Anyway, that's all I got for this week. Thanks so much for tuning in. I think the next week ahead could be a really good one. It's my feeling. We'll come back and talk about it next week though, and I'll let you know whether or not it was good or not, right? And we'll keep moving on. Have a great week, everybody. Enjoy your upcoming weekend, and I'll see you next week. Have a great week. Happy trading.